I went and looked up what are the largest target date funds out there. And there's 4 investment companies that really represent the majority of target date funds. And that is Vanguard, Fidelity, American Funds, and BlackRock.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 100. I want to thank those of you who've been listening to many of my episodes. It's definitely quite a milestone to make it to episode 100. I hope to be able to continue recording these episodes for many years more. And this week we're going to talk about target date retirement funds. Chances are that if you are investing in a 401k, you're probably investing in one of these funds and you may not know a whole lot about it. So in this episode, we're going to talk about 4 things that you should know about target date funds. So the first thing is, what is a target date fund? What am I talking about? Well, a target date fund is a mutual fund that has a year in the name. For example, the Vanguard 2035 fund, the Vanguard Retirement 2035 fund. And that year is supposed to correspond to the year that someone would retire. For many people, that's usually the age of 65. So that's how that 2035 portfolio would be positioned for somebody who's turning 65 in the year 2035. The way that these funds work is that they're a preset mix of stocks, bonds, and cash, so that you as an investor don't really need to think a whole lot about how you should invest your money. These companies have done some research and tried to put together the best portfolio for someone who's age 65 in the year 2035. However, there's a number of issues that we'll talk about why this may not be the best thing for you. You may be wondering, well, why am I invested in one of these? How did I become invested? Well, due to some legislation that took place in 2006, there was a Pension Protection Act that was signed into law, and this was aimed to improve retirement plan design, designed to improve more people saving for retirement. And what that did is it required 401k providers to adopt automatic enrollment features and also have default investment funds. So it used to be that when you started in a 401k, you were probably given a form to select your investments. And sometimes people don't fill that form out. So the default used to be money market. Now, years ago when money market rates were 3, 4, 5%, that was probably an okay default investment. But in recent years, when the rates have been close to 0, maybe 1%, it's not a great investment, especially if that person never went back and updated their investments and they just sat in money market for a number of years. So these target date funds, they had been around for a while, but due to this legislation change, they became the default feature. So now a lot more people are invested in them. Chances are you've probably also gone through a change in your 401k where your company has changed providers. Maybe they went from Vanguard to Fidelity or to Prudential. And when that happens, the company has to determine how the money is going to be reinvested in the new funds that the company has picked. And many times the default for all the old money is to go into target date funds. So those are a couple ways how you may have gotten them, and maybe you just picked the fund yourself due to some education that you did. So how do you compare these funds? Well, there's a few different things that you should look at. One of them obviously being performance, another one being the cost of the fund, another one being the investment allocation. So let's talk a little bit about that. I went and looked up what are the largest target date funds out there. And there's 4 investment companies that really represent the majority of target date funds. And that is Vanguard, Fidelity, American Funds, and BlackRock. So I went and compared these 4 companies' funds for the 2035 fund. So I want to walk through that a little bit and what I looked at. So the Vanguard Target Retirement 2035 fund, symbols VTHHX, and you don't have to remember all this. If you go to retirewithryan.com, you can click on the show notes and I'll have links to all these investments. That fund costs 0.08% per year, and the asset allocation is currently 72% stocks, 28% bonds. And I also like to look at the international allocation because that also differs between a lot of these funds. They have 29% invested in international stocks. Then you have the Fidelity Freedom 2035 fund. The symbol is FFTHX. That fund's a little more expensive. It costs 0.72% per year, 80% stock, 20% bond and cash allocation, and 37% international exposure. Then you have the American Funds 2035 Target Date Retirement Fund. The symbol is AAFTX, costs 0.65%, 72% stock exposure, 28% bond and cash, 19% international, the smallest of the four. And then we have the BlackRock LifePath Index Fund, and that symbol is LIJAX, costs 0.39%, 75% stock, 25% bond cash exposure, and 26% international. So you can see just looking at these four funds how there's differences in the asset allocation, differences in the cost, and also differences in the amount of international exposure. The reason I point that out is because there is a large universe of stocks that you can invest in outside of the US. I've heard statistics that say 60% of the stocks that you can invest in exist outside of the US. However, in recent years, international markets have significantly underperformed US markets, so you might not want to have a very large allocation in international funds. So that's a reason to look further into these funds and determine which ones are appropriate for you. So depending on your 401k provider, you have whatever the target date fund family is that they have chosen. Usually they choose one family, because the other thing that differs is that these funds over time, the way they're designed is that they start out more aggressive, and the closer you get to that retirement year, the more conservative they get by shifting more money into bonds and into cash, so that you as an investor don't have to keep an eye on your portfolio. It's essentially done for you. And then once you reach your retirement date, then the fund is somewhat static in that it doesn't really move much more conservative. It kind of holds at a level anywhere between 40% to 50% in stocks and then kind of stays there. So should you be investing in these? Should you continue investing in them? Well, the first thing every investor should determine is, what is your target allocation? How much are you comfortable having invested in stocks, commodities, and real estate, investments that have the potential to grow more but also will fluctuate a lot more in price, versus bonds and cash? So once you've determined that, and everyone is different, what may be appropriate for your coworker who's turning 65 in the next 10 years versus for you might be totally different, right? Everyone has a different tolerance for risk. And so first, after you've determined that, then you'd want to investigate the target date fund that you were maybe already invested in, or some other options to align that allocation with the target date fund. So if you're looking to not have to really worry too much about your investments, that's certainly a good option. Additionally, once you've determined this asset allocation, you should be monitoring it and rebalancing, meaning that if your target allocation is 60% stocks and you find that the stock market goes up a lot and all of a sudden you're at 70% stocks, well, you should sell some of those stocks to get back to 60% so that when a market decline comes, you're not hit greater than you were comfortable. The opposite could be true. If markets are down, you'd want to be buying more stocks. So it is nice that that process is automated for you if you use a target date fund. However, many 401k plans offer automated rebalancing, so that shouldn't be your sole reason for using a target date fund. There are some negatives, however, with target date funds. One being the investment allocation may not be appropriate for you in the sense that if you wanted to have exposure in your portfolio to real estate funds, to commodities funds, many target date funds don't have investment exposure to those. Additionally, target date funds range in cost. Maybe you have a selection of target date funds that have low cost. Maybe you have a selection of target date funds that are high cost. So it might be possible that if you selected from other investments in your 401k, that you could actually put together your own target date fund, so to speak, that maybe had greater diversification and lower cost. Additionally, if you want to have more control over the weighting maybe in the different sectors of the stock market that it's investing in or in the bond market as well, you'd also want to think about having your own funds that you pick versus using a target date fund. So if you are invested in a target date fund, and you'll know that because the fund will have a year in the name, I would definitely investigate a few things. What is the asset allocation in that fund? What is the cost that you're paying? And then look at the other potential options in your 401k. Are there other funds with low costs, preferably index funds, that you could choose from that maybe would have collectively lower costs than using a target date fund? And would you also maybe want to change the allocation that you're in to maybe something that's more suitable? A good episode to go back and listen to would be episode number 17, the 5-step portfolio process. I'll put a link in the show notes if you want to go back and listen to that. It'll further discuss this process of building your investment portfolio. Additionally, when you are retired from a company, you do have the option to roll over the money, especially if you're in a 401k or retirement plan that has limited investment choices or maybe high costs. Then you could definitely benefit by opening up an IRA with one of the large discount brokers, Fidelity, Charles Schwab, Vanguard, and setting up an account there where then you have greater investment selection to put together the right portfolio. So I hope this episode was helpful on understanding target date funds a little bit better. And if you've been enjoying these episodes, I always appreciate you sharing the podcast with someone else. I'm trying to continue growing the listenership, either letting a friend or coworker who's thinking about retirement know about the podcast, or if you can share it on social media. If you're on Facebook or LinkedIn, I post the episodes to the Morrissey Wealth Management Facebook page, and you can go there and share the episodes, or you can just share them right from your favorite podcast app. Have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.